Well, you got to be flipping my flapjacks. Congratulations, everyone out there closing their portfolios today at an all-time high or close to an all-time high. It was definitely not too far off in regards to the public account here today. Well over $3.9 million in the public account. I got a very important subject I want to speak about at the beginning of this video, very serious subject. A problem I see out there in the market, retail investors. I need to speak about this and make sure that point's really understood out there. So I want to speak about that at the beginning of the video, okay? From there's a couple of videos I want to go ahead and react to. One is Dan Niles here speaking about don't confuse stock prices with company fundamentals. I'm looking forward to reacting to that one. Then I want to react to this one. AI-driven bull market will continue, but a near-term pullback is likely, says Julian Emmanuel. Looking forward to reacting to that one. From there, I want to go ahead and show you guys, I'm just going to drop some gems in regards to running projections on a company. And the reason being is I was showing some projections in this video I did last night, 7 stocks you must buy before 2026. But some people didn't understand like how to run projections or how it works, and they're like, why is this number like this and this number like that? You know, and I understand there's a lot of new people in the market that haven't been doing this a long time. So I'm going to show you guys how to properly run projections in this video and how to actually think about this as a long-term investor in the market. Okay, so I'll actually run projections live for you guys in this video. Okay, and then the last subject I want to speak about here today is these, like, let's call it fast casual type stocks are getting obliterated. Chipotle down 34+% year to date. Cava down 42% year to date. Sweet Green down almost 75% year to date. We're going to talk about if there's opportunities in those stocks and if this is a time period you should be buying or is a time period to stay away. So hope you guys get a lot of value out of today's video. I appreciate y'all for joining me for this one, very serious one. And like I said, I got some gems to drop for you guys, some reactions. This is just going to be a great video overall. So I appreciate you. One thing only I need from you guys. If you haven't already done so, and I appreciate everybody that's already done it, and I don't even need to say it, but for the people that haven't done it, please hit the like button on this video. That's all I need from you. If you could just do that, that would mean the world to me. If you want to be subscribed here to the channel, you can certainly subscribe. We are now, I think, 108,000 subscribers, 107,000, somewhere around there. Okay, appreciate y'all for being here. So I want to talk about a very serious subject at the top of this video and an issue I'm seeing. Okay, so listen, I have seen recently Joseph Carlson's getting some hate in regards to Duolingo stock. So Duolingo stock obviously hasn't done well. We all know that, okay? But I have an issue with this. And I have an issue with people talking crap, waiting for somebody's downfall. And for what reason? You know what I mean? Like Joseph Carlson had a ton of successful stocks over the last several years, right? Let's say he gets Duolingo wrong. Let's say, you know, it doesn't work out. Let's say Duolingo's wasn't the one, right? And let's say it's, you know, 2-3 years in the future, and Duolingo's, you know, same prices today, maybe lower, maybe $100-something, right? And let's say he was wrong on that. Okay, big deal. Big deal. What does it matter? Like if you understand, in this game, you're never going to bat 100%. Ask any great investor who does this over 10, 20, 30, 40, 50 years. They all tell you that. You're never going to bet. I've been in the market 17 years now. There's been plenty of stocks I've gotten wrong in the last 17 years. Some I got wrong in the respective I didn't see the future and I didn't invest in, and it was like the next big opportunity. Some where I invested into it, I thought it was the next big opportunity, I lost a lot of money. That's a cost of doing business as being an individual stock picker. You have to accept that. No, you want to try to minimize as many mistakes as possible and try to have as many successes as possible. No doubt, right? But what good does it do to tear down somebody else? Like, does that make you feel better? Like, that's just crazy to me. But you got to understand, there's people that have been waiting, you know, to tear him down, right? Just like there's people waiting to do what? Tear me down. So, you got to understand, back in 2022, I got torn down. They shredded me out there, right? Everybody made fun of me, you know, and I understand, like, some of it was my fault, and then some of it was the market. Like, the market, you know, peak to trough, Nasdaq fell like 37%. I was getting obliterated out there. It was like everything I touched was going down, pretty much. I mean, Meta went down to $88. You know, my small cap stocks sucked. Like, it was brutal. I was getting brutalized, and everybody came. I don't want to say everybody, but a lot of people came for my head, right? And a lot of people had been waiting on that date. And the reason being, I had been hot in the market for several years and I had a lot of success. I'd made a lot of money on stocks, including obviously Tesla, right? I was able to capitalize on that massive move, in Tesla stock all the way from like, it was like a, $15, $20 stock all the way to like 400. It was unbelievable. And so a lot of people have been waiting for me to, like have a tough time, and I had a brutal time. I don't think I'm hopefully setting myself up to never have that brutal of a time again, like I had in 2022. But the moral of the story is, like, the next bear market, there's going to be plenty of people that, are going to be hating on me, making fun of me, and I'm going to see who's out there for me. Because it's always in the bear markets that I see who's really riding with me or who's not. Because at the end of the day, like, there's people watching this video right now that can't wait for my downfall. Literally right now. And the thing is, a video like this might get 70,000 people to see it. Like, I don't know how many people will watch this video, but let's say 70,000. That's probably like the average for this channel, right? Of that 70,000, I think there's probably about 1,000 people watching this right now that are waiting for my downfall, that are waiting for my stocks to suck, that can't wait to make fun of me, that are going to be leaving nasty comments, making fun of me, that are going to be engaging in all that sort of stuff. And it's crazy, because what good does that do for you? It does no good for you. It's not good for your mental health. It's not good for your wealth. It's not good for anything. And so, but you got to understand, like, there's people waiting, and they're waiting, and they're waiting. And the next bear market, when my stocks are going down, my portfolio is going down, believe me, they're going to be out there to make fun of me and talk trash on YouTube and talk trash on X and all this stuff. So just understand that. And we'll see how many of you guys are there for me, when that time period comes. And so when I see that Joseph Carlson stuff, making a big deal about this, and they can't wait to, attack him for this, I'm like, dang, man, the guy's had so many successful stocks over the last few years. And yet, this one he might get wrong, or it's going through a troubled time. And look they were just waiting. They were waiting to pounce, right? Now imagine if he has a second stock go bad. Oh my gosh, it's going to be, it's going to be nasty. And I have such an issue with somebody like that. You know why? Because somebody like that is actually preaching good fundamentals. They're preaching good fundamentals. They're not giving you some pie in the sky thing about, like, oh, this company has no revenue, but someday it might do a lot of revenue. Like, they're not giving you some crazy, like, ridiculous stuff. Like, he's just, if anything, Joseph Carlson, some people would say he's maybe investing too boring of stocks. Like, if that's your criticism, like, okay, that's not the worst criticism, right? And so that's a guy actually teaching good fundamentals. I think he's got his head on straight. I've watched plenty of his videos over the last few years, and I'm like, of the people, you could go after, I'm like, really? Him? Like really him? There's a big difference between somebody like him, right, and somebody like a Cathie Wood, right? Cathie Wood, look at this. Over 100,000 people watched her latest video from 3 days ago. Now her views have dropped off a cliff. Obviously, she used to get like 1 million views or 800,000 views a video, 500,000. It was just ridiculous, right? But Cathie Wood's actually somebody that deserves a lot of criticism. You know why? Because Cathie Wood's 5-year performance with ARK is down 10%. So if you invest in ARK the last 5 years, you've lost money. And this is a woman that is supposed to be a professional investor that, is running an ETF, gets platformed. Like, how many times have we seen her go on to CNBC and Bloomberg and all these different networks and, like, platformed like this in massive podcasts? And for what, negative 10% over the past 5 years? Meanwhile, the S&P 500 has gone up 94%. The QQQ has gone up 114%. Like, if there's somebody that deserves some criticism, like, that would be a person that deserves some criticism. Somebody that's preaching crazy stuff and has those sorts of returns over time, right? So, in another part that I got to bring up here, right, is Tom Lee. Now, the thing with Tom Lee is, and this is a subject I want to speak about here before we get into those reactions and I take you guys through how to run projections properly and all that good stuff. But, Tom Lee, there's an issue here, okay? Tom Lee makes a lot of big, bold predictions, okay? Bitcoin can easily get to 200,000 before year end, right? What was it? Wasn't it last year? You guys that follow me religiously on the reaction channel, what was it? Was it last year that Tom Lee said something to the effect of, small caps are going to go up like 50%? Remember we were reacting that here on the reaction channel? You guys can refresh my memory on that. If I recall, he was making some sort of call that small caps are going to go up 50%. That never happened, okay? Tom Lee makes a lot of big predictions. Some come true, some don't come true, okay? But he makes a lot of big predictions. And the issue we have here with somebody like a Tom Lee, right, is, everybody loves him for his bold predictions in this sort of market that we've been in, right? But believe me, when we go through this next bear market, whether that starts in 26 or 27 or 28, whenever it starts, or this year, I don't know, whenever that bear market starts, just understand Tom Lee is going to get a level of hate that, it's going to be pretty extreme. So just do understand that, folks. And it's not my first rodeo in regards to seeing this. I've seen this play out before. I just watched it play out a few years ago. You understand, Tom Lee was loved in 2021. And, by the halfway through 2022, he was getting obliterated, right? Everybody was making fun of him, calling him names and saying this and saying that. So the biggest thing that I want you guys to take away from this, okay? The biggest thing, let me pause this, landscapers are here, and then I'll restart, and I'll tell you guys what the biggest takeaway I want you guys to take away from this is. So the biggest thing I want you guys to take away from this is do not, I repeat, do not engage with this behavior that is rooting on people's downfall, that is hating on people, because it will do absolutely nothing good for you. I'm a big believer also in karma. I've always been a big believer in karma, like a huge believer in that, and the way you treat people, when they're down and when they're up, in those sorts of things, right? And how that comes back around. And I don't know, maybe there's something to that. Maybe there's nothing to that, right? But I'm a huge believer in karma, right? And I've seen some people treat some people very bad, and it comes back around to really bite them. And I've seen some people, handle tough times really well and not take it out on others. And those people end up actually doing very well long term, essentially, because at the end of the day, what you can control is your income, your expenses. What you can control is, do you invest in yourself? What you can control is where your money goes. What you can control is running projections on stocks, doing research on stocks, running your portfolio. You can control all those things. You cannot control whether the stock market goes down or up in the short term. You can't control whether a stock goes up or down in the short term, right? You have there's nothing you can do about that. That just is what it is. And you can also control whether you engage into activity that is like hating on others and rooting for them and rooting for their downfalls and all those things like that. Like, it's just not behavior you want to engage in. It's tough to get places with that sort of behavior. So keep that in mind, folks. Take that with you, and let's make sure we're not doing that sort of stuff. Okay. Alrighty, next up here, let's react to some Dan Niles video here on the market, and then we'll react to this one, Julian Emmanuel.
Great to be on, Melissa.
It certainly doesn't seem this way, that there is an adoption slowdown when you go through earnings calls, when you hear what companies are saying, but there could be a difference in what they're broadcasting versus what is actually going on in terms of dollars spent. What's your take on this? Because there's always that concern that there's a pull forward, that the expectations were just being bloated to begin with, and that it will catch up with this trade.
Yeah, I think the tough thing is, don't confuse what stock prices are doing with what's actually going on fundamentally, because those two things can be completely different for short periods of time. And that's what you have going on right now. You were talking earlier about, the Fed cutting rates, starting again that cycle on September 17th.
Oh my goodness, these landscapers are something else. This is the whole situation going on.
Rates starting again that cycle on September 17th. And that's driving these stocks up. But if you listen to what is actually coming out from these companies, it paints a slightly different picture, right? Where, remember, there was an MIT study that came out that 95% of companies weren't seeing any, improvement from their spending on AI. Then you get to company actions, which matter more than these surveys, and you go, all right, Meta, which has been absolutely killing it with their Llama models, now there's talk that they're going to work with either Google or OpenAI to get Llama 5 out. And after spending Major League Baseball pitcher type salaries for AI researchers, they've probably now restructured their AI team at least 4 times in the last 6 months. You look at what's going on with Apple, right? They announced all these AI features for Siri in 2024, but it'll be probably 2026, and they're going to have to work with OpenAI or probably Google following this antitrust ruling to get those features out. So you are already seeing this, and over the weekend it came out that OpenAI has sort of pushed up their revenue forecast for 2030 by about $26 billion to $200 billion. But to get that revenue increase of $26 billion, they're going to have to burn $85 billion more in cash. So the data points are definitely there, but we're in this business to make money. So you have to go, all right, well, do the fundamentals matter right now? Or is it the fact you're going to get even more easy money? The 10-year yield's going down to 4%. And so this market, much like in 2021, will keep going up right up until it doesn't. And so I think you have to look at that. And NVIDIA missing on data center revenues. And you can say, yes, but the growth was so high and all this, but they missed. So that should give you another data point, and you throw on top of that Dell or Marvell, or the fact that Avago's got more ASIC revenues because companies want to cut their costs. Those all speak to the same narrative. So don't confuse the actual data with what the stock prices are doing.
Dan, I think, people who are believers, who are basically...
So let me just push back against Dan Niles for just a moment there. Okay, listen. In regards to NVIDIA, here's the deal. You can't draw too much of a conclusion from one quarter. You got to see a trend, right? You got to see a trend. If you see next quarter, they also missed data center revenue, or let's call it barely come in line. Ooh, okay. Now you got a problem with NVIDIA. One quarter, next quarter, don't be surprised if data center revenue comes in and smashes for NVIDIA. Do not be surprised at all. So, you got to understand with NVIDIA, there's going to be a time when NVIDIA is going to be having really troubling numbers, but that's still like a year to year and a half out. And when I say troubling numbers, like almost any other company would take those numbers, but what it's going to be is it's going to be really slow growth rates. But that's still like a year to year and a half out, in my opinion. So, the death of NVIDIA and NVIDIA stock has been greatly exaggerated. Like I continue to say with NVIDIA, it's just range bound. And it's going to remain range bound for quite a while, in my opinion. When people are feeling real bullish around NVIDIA, right? Let's say they come out next quarter and data center revenue smashes. Stock goes 200-ish range. And when people go bearish over the next few years, the stock will go down to probably 125 or so. And so I just feel like the stock for years is going to be stuck in this 125 to 200-ish range, and it's just going to kind of be somewhere in there, and that's going to be for the next several years, in my opinion. And so, once again, people go bullish, going to push up to that 200 range. People feel bearish, going to push down to the 120, 125 range, and that's just going to be the game. And I think that's the game for the next several years with NVIDIA stock. And so that just is what it is.
Not committed to this whole CapEx story will say, well, sure, companies are not yet seeing the benefits, or they're not yet accelerating their adoption of various AI tools because we're not there yet. And we have to build as fast as we can to get there. The market's permitted a lot of these companies, the entire infrastructure trade, to go pretty far at this point. Is there any sign that the market's going to kind of tighten the reins on that?
Well, number one, I would disagree with your premise that, it's okay to not see returns. We're 3 years into this, Mike, right?
I didn't say it's okay. I'm suggesting the market's been okay with it.
Hold on, Dan Niles. We're not really 3 years into this, in all due respect. So this AI cycle started to take off at let's call it in 2023, right? So that's when you started seeing the first big orders of AI chips roll through. Okay, so then last year was a let's call it an uptick year, and this year's a further uptick year. If you're on the side of trying to make money from AI, here's the deal. You're way too early in the cycle to really be showing any meaningful returns yet, unless you're somebody like a Meta or maybe a Google, somebody like that that's already got it, or ChatGPT's seeing returns on obviously their investment and whatnot, right? But you're still too early in regards to having to see a return right now. A lot of these software companies, like even a Salesforce, for instance, right? A lot of their big, let's call it increases of revenue, will come in 26, 27, 28, 29. That's all still rolling down the road. Palantir's obviously started to see a very meaningful uptick in regards to their revenues. But it's a game that's got to play out. To say it's 3 years, a little bit false in my opinion. We're more like a year and a half to 2 years into at least having an ability to start to generate some revenue from these chips you're buying and what that ends up producing at the end of the pie.
Well, but again, that kind of goes back to the fact that we're looking at rate cuts coming, right? That's been the number one driver of this market really since COVID, and you can argue since Lehman failed, right? So, you have inflation going from 1.4% to 2%. 1.4 to 7% in 2021. The S&P is up 27% because the Fed keeps telling us it's transitory when I think a lot of people, including myself, thought it wasn't. Then 2022, You admit to it, rate.
I got to push back against Dan Niles again. I love Dan Niles, but man, I got to push back against this. Hold your horses, Dan Niles. What he just said there was just preposterous, just ridiculous. The main driver of this market, since even Fannie has been rate cuts and rates. No, in all due respect, Dan Niles, it's been earnings. Same thing since COVID. He spoke about COVID there. Since COVID, it's been the main driver. No, earnings. Have you seen look at Apple's earnings per share before 2020. Look at their earnings per share now. Look at Google's earnings per share before 2020. Look at Google's earnings per share now. Look at Meta's earnings per share before 2020. Look at their earnings per share now. Look at Nvidia's earnings per share before 2020. Look at it now. Look at Amazon's earnings per share before 2020. Look at it now. No, nothing about rate cuts. The driver of this market since Fannie Mae and Freddie Mac in 2008, 2009, and the driver of this market since Rona has been earnings, in all due respect. Nothing about rate, that's irrelevant in the conversation, just to be quite frank. Irrelevant.
Hikes happen, the market gets beat up pretty good. 2023, the Fed goes ahead and goes on hold this year, and the market obviously surges over 20%. This year, it looks like rate cuts are coming, market starts going up. And so that's doing a lot of this driving of it, and that's why it makes it seem like people are okay with this, because don't forget, Nvidia is down since they reported. Obviously it surged a lot off the bottom, but don't forget, middle of last year when Microsoft, Google, Amazon all had CapEx spending going up while the revenue estimates were actually getting cut, Nvidia went flat, went sideways for the last half of last year. So, this is a point in time. The rate cuts in front of us. That's why if you see a lot of the things that I write, it's, forget about valuations, forget about fundamentals. It's all about easy money. And the party's going to continue right up until it doesn't. My thought has been that's around Thanksgiving when, we find out there has been a big pull forward in demand. But in the near term, the goal is to make money, right? And then being intellectually right, that's something that ultimately will help you make money on the other side of this by being short a bunch of stocks. And I think we're getting closer to that. But for right now, it's stay long and make money.
So Dan Niles says, for now, stay long and make money. So that's his perspective. Okay, next one up here. AI-driven bull market will continue, but a near-term pullback is likely, says Julian Emanuel.
It's a buying opportunity, especially for AI-driven leaders. So here with more is Evercore's Julian Emanuel. We were speaking about this earlier on the show. I don't know if you had a chance to listen, but for so long, AI seemed like a buzzword, and all you had to do was just drop it here and there in an earnings call, and you got a little pickup in your stock price. But now we need to really see some of those gears turning. We need to see what it means to actually be capitalizing on AI. What should we be looking for here, even if you see some choppy movement before we really take off?
Yeah, and look, again, if you think about it within the context of the last great technological revolution bull market, the internet of the late 1990s, choppy movement is part of the script. And so in that respect, considering we've gone up almost uninterrupted since the April low, which itself was a scary chop, as we know, it's to be expected that we might have a little bit of indigestion, particularly September into October, when we've got uncertainty. We're going to have a payroll revision number tomorrow that everyone is sort of focused on. And again, the inflation figures, tariff rulings from courts, all of these things together. But what we're looking for specifically is the continuation of this dialogue from corporate America in general that we've heard for the last several months, that they're actually becoming front foot on talking about how they're using AI to generate revenue, not just the cost save, it's the revenue generation. And you're seeing it across industries. And for us, that really bodes well for the setup into 2026.
It's interesting because Sherry Paul from Morgan Stanley was on earlier in the show, and she said, yes, of course, there's tariff noise. There's other macroeconomic uncertainty. You're talking about CPI and PPI and maybe a jobs revision. But she says that doesn't really matter so much because innovation is where it's at. You've got to stay focused on AI. But you're sort of saying, yes, but we could be choppy getting there because of those macroeconomic headwinds. But basically you're saying, hold tight, use the opportunities.
We are, because again, going back to, and if you think about sort of February, March, and April, great bull markets, and this is a structural AI technology-driven bull market. Great bull markets find ways to try and to get investors to get off the theme, to do some selling. And our feeling here is you don't do that, because basically when you think about it, what really drives stock prices higher in the long term is earnings. And we're very optimistic on earnings into 2026.
Okay.
So, what do I feel about near-term pullback here? So listen, you can stress yourself out so bad about near-term pullback, when's the perfect time to buy, all these sorts of things. The bottom line is Google going to be a lot higher 3 years from now, 5 years from now than it is today? Where do you think their revenue is going, their net income's going the next 3 years, 5 years? What about Amazon? What about Meta? What about AMD? Like run your numbers, run your projections, look at the valuation. We're about to run projections here in just a moment. Don't stress yourself out too bad about if the S&P 500 is about to go up or down the next 5-10%. Because I think Warren Buffett or Peter Lynch or somebody famously was quoted saying, I can't tell you where the next 10% in the S&P 500 is, whether it's up or down, but I can tell you where the next 90% gain or the next 90% move in the S&P 500 is, right? It's higher. And so 100%, whether we have a 10% pull down or 10% up move, who knows? But the next 90% is higher. The next 100% is higher. The next 500% is higher. It's up. So just something to keep in mind there. So let's do some projections. And once again, this is on the back of this video I did on the main channel last night called 7 Stocks You Must Buy Before 2026. I was showing some projections in that video, and some people didn't quite understand how running projections works and what matters and doesn't matter and those sorts of things. Okay, so we have two different projections on 1000xstocks.com. Okay. Now, if you want access to this, you can always go to 1000xstocks.com. You can apply for access. Also, the pinned comment down there is if you want to apply for access to my private stock group plus 1000x access. Okay. But we have two different ones. This is intermediate projections, which is where you run a bull case, base case, and bear case on a stock. Okay. And then we have another one, which is called advanced projections. Now, this one goes crazy. Okay. This one, you can adjust revenue growth, cost of revenue, you get your gross profit margin, your operating expenses, how much you think that's going to go up or down over the years, operating margins, other expenses or income, essentially, your net income margins. Then you can basically, if you think there's going to be big share buybacks for a stock over time, they're going to take shares off the market, you can adjust for that. If you think there's going to be major dilution for a stock or minor dilution, you can adjust all those numbers. Listen, I think for 90% plus of people, this is a little much, okay? And then you run your projections all the way out to 2030. So what we're going to stick with is intermediate projections for this video, and I'm going to show you how this rolls. But we have this for advanced people that, because we have a lot of private stock group members that, some are newer to the market, as in they've been in there, just in the past year, last few years. And we have other people that have been investing for 10, 20, 30, some even 40 years. And so they love the advanced projections. Saves you so much time. And you've got to run projections on stocks. If you don't want to use 1000xstocks.com, build your own projections in a spreadsheet. That's a great place to start if you're not ready to, join something like 1000x. It's a pain because you got to build it. You got to make sure all the calculations are right. Then you have to manually import numbers. It's a pain. Whereas something like 1000x, we automatically import the numbers. So let's say Apple, watch. Boom, Apple automatically comes up with their expected 2025 revenue and net income, right? So the numbers are already there. Net income margins are earnings per share. It makes your life so much easier. If you're manually doing this, you got to enter it all in, and then you got to have all your different cases. It's a pain. It's it saves me so much time. It's ridiculous. Okay. So here's a way to think about this. Okay. What stock do we, let's go with a stock like Meta. Okay. Let's run projections on Meta. Okay. So here we go. Boom. It auto-populated the revenue, the net income margins that are expected this year, all that good stuff. Okay. So whenever I run my projections, I'm not trying to cherry pick a revenue growth rate exact on a year by year basis. So I'm not trying to say Meta's going to grow 20% this year, but then they're going to grow 15% this year, and then 17% this year, and then 11% that year. And then that changed the PE ratio. No. Okay. No, I'm not going to, I want to be directionally right. I don't need to be exactly right. I don't need to be in 2029, they're going to have 13% revenue growth. No, I want to be directionally correct in regards to a company like Meta, okay? And that's the same thing. And so, and when I run my projections, I want to just put an average revenue growth I expect for that case over the coming years, an average net income I expect over the coming years, and what's an average P ratio that I think the stock should probably command come 2029. So people sometimes look at the 2025 and 2026 and they're like, wait, you think the stock's going to be lower? Dude, I'm not even looking at that. It's so irrelevant. I'm not investing in a stock for what it's going to do in 2025, 2026. I literally don't care. Like, whenever the stocks I'm buying right now, I could care less what they do in 2025, 2026. If anything, I hope they go down. I'd much rather buy more shares for cheaper. And if you don't understand the concept like that, we got to get you, rolling here in the market and understanding like very simple concepts, right? So I'm really running these projections to see where this company is going to likely be at in 2029 and what's my CAGR between now and 2029. That's what's important to me. So somebody like a Meta, I'll run them at probably on a bull case. I'll run them at let's say an 18% revenue growth rate for a bull case. I think that's a very fair number for average, right? Now they should be able to grow net income at a much faster clip. So I would say somewhere at least maybe 23% net income growth on average per year under a bull case assumption. Now, if you're growing top line 18%, bottom line 23% for a company like Meta, they should probably be able to command, I would say, somewhere between about a 29 and a 34 PE ratio for a company growing at those sorts of rates. They should honestly command higher than that, but it's Meta, so it always has trouble commanding a super high valuation. So under a bull case assumption, I'm looking here. I don't care what the stock is, projected this year. This is irrelevant to me. I care what the stock is likely projected at here, right? So this puts the company at $384 billion come 2029 for revenue, $165 billion net income. That number's never going to be exact. But it's, if a bull case plays out here, it's going to be directionally right? 43% net income margins, right? Gives me a CAGR on the low end 25%, high end 31%. Now my base case is a little more conservative. I'll go about 16% revenue growth on average per year for Meta over the coming years. I'll take that net income growth to about 20% for this particular case, and I'll go down to about a 25 to 30 range for Meta under this particular case. And we'll see what Meta is going to give me for a CAGR here. So under this assumption, basically I should get a CAGR of around 20% a year through 2029 under my base case assumption for Meta, right? Now, once again, I don't care what the stock says in 2025, I'm not even looking at it. I'm looking over here. I'm trying to figure out, is this a good investment for the next 3 or 4 years? What it does over the next 3, 4, 6, 12 months is irrelevant to me, okay? A bear case for Meta would probably be something like 10% revenue growth. This would be, 190%. That'd be nice. This would be pretty disastrous for Meta to only grow 10% a year over the next number of years, and maybe 12% net income growth. So just barely outstripping there. And we can say like a 22 PE on the low end to maybe 27 on the high end would be pretty fair for a company grown barely double digits like Meta. And so even under a bear case, I still get between a 7% CAGR and about a 12% CAGR here. So once again, there's a reason Meta's the biggest position for me in the public count. Like, the stock's it's still a buy. Like, that's the thing about Meta. Like, it's still a buy, even here, right? Now, what about these stocks like Chipotle, Cava, Sweetgreen? Okay, so let's go ahead. Let's, on 1000X here, pull up the compare feature. One of my favorite features on 1000X, right? Like, where are you going to, else are you going to get the ability to compare 3 companies, all these metrics that are relevant to you, all in one place? Dude, every single person watching this, you should have access to 1000X. Like, if you don't have access to 1000X, like, I don't know what to tell you, man. Like, bad financial decision. Like, everybody should have access to this. Okay, Sweetgreen, and then we're doing Cava. Like, where else are you going to be able to do this at, man? It's insane. So what we're going to find here with these, right, is they're all valued very differently. So Sweetgreen's unprofitable, right? So we're not even getting PEs on Sweetgreen. Chipotle's at about a 32 forward PE, 27 2-year forward PE. Cava trades really rich, but keep in mind Cava's much higher growth than somebody like a Chipotle, right? Chipotle's current year expected revenue growth is around 7% here based upon analyst estimates. Cava's expected to be like 27%. And you look at next year's revenue growth, Chipotle's supposedly supposed to get back up to 13%. Analysts might be too bullish on Chipotle, by the way. Cava's supposed to do about 19%, right? And Cava obviously has a much bigger opportunity to expand a lot of locations. Like, Cava has a very small amount of locations compared to something like a Chipotle. So if I look at this, the issue with all these companies is Sweet Green's a money loser. So you're like, I don't know if I'm going to touch a money losing company like a Sweet Green, right? Chipotle still trades rather rich if you feel like these growth rates are unrealistic. And if you feel like Chipotle is just going to be a single digit grower from here, then you can make an argument that Chipotle is a little rich here. It's not super overvalued. It's just maybe a little rich if you think it's a single digit grower. Now, if they get back to double digit revenue growth, that's a whole different story then. Because then if Chipotle was able to get back to double digit growth, right, in revenue, and then they continue that for the next several years, I can make a strong argument that Chipotle is undervalued here. But that's a debate if they're going to be able to get back to double-digit growth. Cava, I ran projections on Cava here. So let's go back to intermediate projections. So we have the ability to essentially save your files now, which is very nice. So if I recall, I saved Cava here. So let's load data for Cava. Hey, that rhymes, huh? Data for Cava. So here's my Cava bull case, base case, bear case. Under the bull case, I had them doing 25% revenue growth per year, 2026 to 2029 on average, net income growth of 40%, so at a much faster clip. Puts them at net income margins in the 8s, which isn't a crazy number for Cava over time. Like Cava should get to 10% plus net income margins in the 2030s, right? So I don't think somewhere in the 8s is crazy come 2029. That would actually give you an amazing CAGR on this one, 24% on the low end, 32% on the high end, right? But I have it on a 70 to 90 PE ratio because they would have such big growth rates that they would be able to command a big valuation on it, and people would still look at it as there's still a massive opportunity to open so many more restaurants after 2029. Now, my base case has 20% revenue growth, 35% net income growth, 60 to 80 PE ratio, which if they're growing 20% top line, 35% bottom line, and then people still think there's another 1,000 or 2,000 restaurants to open, like a 60 to 80 PE is not crazy at all. That gives you a CAGR of 15% low end, 24% high end, which isn't bad. That's pretty dang impressive. Now, my bear case, a little, troubling. This would be 15% revenue growth top line, 20% net income growth bottom line, 40 to 60 P, which, you could say is still very high based upon the market, but not crazy based upon those sorts of growth rates. But there, you'd have trouble making money in the stock over the next few years. So if that bear case comes true, Cav is very dangerous. You could be stuck in the stock and make no money for the next years, right? All the way through 2029, that'd be brutal. So, that if Cava keeps falling, maybe I step in, but we'll see. We'll see. There's a lot of opportunities in the market, and cake's one of the best opportunities. I haven't saved up my cake projections yet. Maybe I'll share those with you guys in the future, okay? Hey, if you guys are looking to join my private stock group, apply to join 1000xstocks.com, all this stuff. Pin comment down there, click on that, fill out a form. Let's get you a higher level. We need everybody in 1000x. Like, this is just a product that everybody should have access to. If you're not running projections on your companies, you're doing it wrong, man, okay? All right, guys, much love and have a great day.